My wife insists that Mastercard is the stock to buy right now. She said we can be rich buying the stock. I don't buy hype, so I am going to do some study and not follow blindly. But how do I start? The point here is to be rich. Maybe I need to study how much the stock can make me in 10 years' time. Let's do this by estimate. How much is the company profit in 10 years' time? Since everyone in finance is telling me to use EBITDA, I am going to use EBITDA. For those who don't know, you can understand it as a type of profit. We'll extract the data from stockanalysis.com. Think about it. Where do you think this number lands? Will the EBITDA be higher or lower? So in 10 years' time, based on the last 10 years, annual growth rate of the company, 14.3%. And assume the growth is slowing down year over year. Mastercard EBITDA will be $50 billion in 2034. Right now, people is buying the stock around 29 times the EBITDA. It means if a company now profit $1 a year, people will buy it with $29. In last 10 years, people usually buy the Mastercard stock with 28 times the EBITDA. As I personally think, dividend received is my profit too. I will be adding up the dividend I am getting in 10 years' time. So, to get the final price of the stock, I will be adding up 28 times the EBITDA plus the dividend, and the stock price is expected to be $1.9 thousand. Right now, the stock price worth $552, meaning I will earn 2.4 times my investment. Putting in $1,000 will earn around $2.4 thousand in 10 years' time. Sounds like a bargain, but the finance people also says best way of investment is to put in trust fund. To be rich, I would need to beat those giant S&P and QQQ. Similarly, I extracted the data from stockanalysis.com using S&P 500 stock growth in the last 10 years. I am assuming 10 years later, it will be 2.2 thousand, giving myself 2.6 times profit, and QQQ will be giving me 3.4 times profit. Now, in comparison, buying Mastercard stock sounds like a bad idea, lower than QQQ, but hold up. After some research, they are saying cash is king. Do you think their cash performance can be better than the QQQ? All right then, I am using the same method, estimating the free cash flow 10 years later. The stock price will end up to be $1.9 thousand, meaning putting in $1,000 will be earning around $2,000 in 10 years' time. Sounds like a bad idea. Lower than QQQ. I personally like dividend. Let's use the same method on dividend gain. The stock price will end up to be $1.7 thousand, meaning putting in $1,000 will be earning around $2,000 in 10 years' time. Sounds like a bad idea. Lower than QQQ. Let's average all three method, taking all consideration, and see how it goes. The stock price will end up to be $1.8K, meaning putting in $1,000 will be earning around $2.8 thousand in 10 years' time. Sounds like a bad idea. Buying Mastercard can get us 2.8 thousand, and QQQ is getting us 3.4 thousand. Seems like buying QQQ is a better idea. Okay, the number seems terrible, but why? Let's study more about their business to understand more. Let's quickly break down the general information and the segment analysis. Starting from the general information. In short, so, what does Mastercard actually do? You see them everywhere. They connect your bank. With a merchant's bank, it's a secure network, and they make money on fees every time you pay. The management is strong. They are pivoting hard toward digital services. Their future, it's all about value-added services. Things like cybersecurity and using AI for fraud. They are also expanding into B2B payments and real-time transactions. They are thinking beyond just your card. Okay, I don't think that's enough. I know their story now. But how did Mastercard earn their money? Maybe we can understand it by knowing how the business earn. First, revenue by segment. To understand, where is the revenue coming from? 38% of revenue by segment is from Europe, 24% of revenue is from Asia Pacific, Middle East and Africa, 22% of revenue is from United States, 13% of revenue is from Latin America, 2% of revenue is from Canada. Next, the CAGR of respective revenue by segment, to understand if these segments are growing well, or if there is any outlier on dip or growth 21% for Europe, which is above benchmark, 17% for Asia Pacific, Middle East, and Africa, which is above benchmark, 9% for United States, which is above benchmark, 22% for Latin America, which is above benchmark. In reviewing the segment performance, a clear narrative emerges. Growth is strong across most regions, with all major revenue contributors for up Asia Pacific, Middle East, Africa, the United States, and Latin America, demonstrating a CAGR above the set benchmark. This suggests a healthy, expanding global footprint for the business. So now we know the potential return and what the business is about. Is that enough to make an informed decision? That is not quite right. You see, buying a stock without checking the financials is like marrying a partner based only on their looks. It's gambling, plain and simple. If you've watched this far, you're serious about investing, and we need to run the numbers. To do that quickly, I developed a 22 checklist that pulls insights from the balance sheet, cash flow, and income statement. Running these 22 checks manually is tedious, so I use the fast download feature at stockanalysis.com to pull everything to Excel for calculation. This is the fastest way to get your insights. You can access the data and my recommended tools through the link below. Use the discount code STOCKSNACK. Starting off with balance sheet, we are checking 7 metrics. Out of the 7, we got 5 metrics with good score. Here's the story. It's a strong one. You look at the cash position, it's excellent. They have more than enough cash. The money they bring in, it easily covers their long-term debt. They generate cash fast. That's a sign of real financial health. But here's a twist. They have used a lot of debt, historically. Maybe too much. Their funding is mostly equity. True, but that long-term financing mix, it needs a closer look. The reliance on debt is higher than you want to see. It's a red flag right there. But they don't use preferred stock. 0, in fact. That's good news. It means they don't need fancy, expensive financing. They fund themselves. They are growing too. The retained earnings. They're compounding fast, even through economic downturns. That kind of growth power that shows resilience. But here's another thing I noticed. They haven't been buying back their shares much. No treasury stock accumulation. That's a missed opportunity. A shame, honestly. Buying back shares boosts value. They could be doing more for shareholders there. Now, let's talk returns. The row is huge. Massive, actually. They are masters at using shareholder money. They generate value from that equity base, and the ROTA. Also phenomenal. It shows efficiency. They are utilizing every asset they have, the whole picture. It's a powerful, cash-generating giant. A few debt bumps and missed buybacks, but mostly it's a machine. A very profitable machine. Next is income statement. We are checking 9 metrics out of the 9. We got 8 metrics with good score. Let's talk pure profit. It's insane, really. Their gross profit. It's the whole revenue. That means absolute pricing power, total control. They charge what they want. The banks have to pay it. Now, expenses, selling and general admin, SG&A, is a bit high. It's over where you want it to be. This suggests the product doesn't entirely sell itself. They have to spend a lot on marketing. They have to spend on outreach. That high expense ratio is a drag. But look at R&D, research and development. It costs them next to nothing. 0 in the grand scheme. This shows it's a simple business model at its core. A beautiful, simple network. They aren't pouring money into risky new inventions. The network just works. And the debt costs, they're tiny. Interest expense is a joke. It barely touches their operating income. This is what you want to see. It means the debt they do have is managed brilliantly. Super cheap financing. Tax time is clean. Their tax rate is very predictable, right around 19%. Credibility with the tax authorities, no crazy tax loopholes or risks. Just stable, reliable reporting. And here's the kicker. Net income margin. It's above 40%. 40%, that is pure competitive advantage. That kind of margin is rare. It screams moat, a wide, deep moat. Earnings per share. It's growing consistently. Consistently and fast, way faster than inflation. This stock creates wealth. And finally, that debt payback. They can pay off all their debt with 1 year of operating cash. 1 year, that's a fortress balance sheet. It's a machine built for profit. Next is cash flow statement. We are checking 6 metrics. Out of the 6, we got 5 metrics with good score. Okay, final piece of the puzzle? It's all about the cash. First, employee compensation, stock options. They give out stock, but they do it responsibly. The dilution is minimal. It's tiny, actually. That's a win for shareholders. Your ownership stake is protected. Now, let's look at earnings quality. Operating cash flow versus net income. This is important. You want cash flow to be higher than profit. It means the earnings are real. For Mastercard, it's close, but cash flow often lags behind. It's slightly lower than reported income. That's a small yellow flag. You have to understand the difference. The quality of those reported earnings. It needs a moment of scrutiny. But when we look at growth, free cash flow growth, it tracks net income growth beautifully. The ratio is perfectly aligned. This means they don't have sudden massive cash needs. No unexpected spending. The growth is honest. And speaking of spending, capital expenditures, the money they spend on stuff, new servers, new buildings, it's almost nothing. Very low capex compared to their profit. They don't need to reinvest heavily. The network is already built. That makes the cash flow truly free. And finally, what they do with that cash. The capital allocation. They pay dividends, they buy back stock. They use almost all their free cash flow for this, 98% of it. This is a mature company. They are returning capital to investors. It's all coming back to you. They are not hoarding cash. It's disciplined and highly rewarding. So, the cash story, mostly excellent, a world-class operation, a true financial fortress. The combined financial score is good, 18 metrics with good scoring out of 22 metrics. Now, it is time to make the conclusion. So, is what my wife said correct? Will I lose money buying Mastercard stock? By the profit-wise, buying QQQ or S&P 500 is having more potential than Mastercard. However, it is having a good financial health. It's a stock worth monitoring. Now, the analysis is complete. Once again, if you need tools for your investment strategy, give a try to stockanalysis.com. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.